Welcome to lesson 5.353 for stocks. This is probably going to be a new concept for most of you, but stocks and the stock market, it's not a hard concept to understand, but there's a lot to it. So this is a large lesson. I'm going to pause about halfway through it and stop this video and start a second video so that you have an opportunity to absorb the material. So let's just start out. Stocks in the stock market. So stocks are a type of financial asset. And stocks are, they're shares of ownership. So when you buy stock in a company, you're buying part of that company. You're getting a little piece of it. When investors buy stock, they become owners of the company. And as owners, stockholders participate in the profit, the good part, or the loss. So if a company goes under, their stock value goes down, and we'll get into that more later. Investors buy stock in hope of increasing their net worth. Net worth is how much money somebody has, how much value their financial portfolio is. But this is not always guaranteed. So let's just say if you bought 10 stocks at $100 a piece, that'd be $1,000 that you spent to buy the stock. If that company went under and that stock went down to $1 and you sold it at $1, well, you're only going to get $10 out of your $1,000 investment. So that's the kind of loss we're talking about. A market, like the stock market, brings together buyers and sellers for the purpose of exchange. We couldn't have markets unless we had these following four things. We must have private property, the ability to own something. We must have competition, and that's among businesses, competition. We must have a profit motive. We have to have the ability to earn money in something for the market to exist. And then we have to have what is called a voluntary exchange system, like the stock market. You don't have to buy stocks. You don't have to invest in the stock market. It has to be voluntary. So somebody that wants to buy stocks can buy them at a stock market. There are two main reasons why we would want to buy stock in a company. We would expect to share in the company's profits called dividends. And we believe the price of a company's stock will rise above what we have to pay for it. Stock trades are handled by a specialized salesperson. You know, you go into a store, a retail store, you see a clerk or a salesperson. But if you're trading in the stock market, you're going to deal with a person that is titled broker. They are brokering your exchange of money for the stock. Okay, on the second page here, what you're going to see is an infographic. It's just an organizer, a way to understand information. And this infographic is about the market for stocks. Now, instead of me talking and writing, I would suggest that you pause this video and fill in your infographic with as much of that information as you really think you're going to need. I would say all of it at this point. So pause here, fill out your infographic, and then come back for me to go over it. Okay, so you've got your infographic filled out on the market for stocks, and this is just a nice way of looking at how everything works in the stock market. It's kind of simplified, but there's a lot of information here. So in the primary market, this company X needs resources to expand its business. So they offer stocks for sale for the first time in an IPO, and that's short for initial public offering, purchased by investment bankers. Then Company X stock is offered for sale by brokers on the stock market. Okay? There's two types of stock market that we use in this country, more that are based here. There's others, but these two. The New York Stock Exchange and the NASDAQ stock market. Individual investor, like you, me, purchases Company X stock online or with a phone call to the broker. So the secondary market is the people who purchase this stock when it goes public. That's us. This is the company putting the stock up for sale through this process with the stock exchange and the stock market. This is us, the secondary market. Okay, so let's take some notes about the primary market. In the primary market, stocks are offered through IPOs. Remember, that means initial public offering to large investment banks. In the secondary market, brokers offer the shares for sale to individuals and institutional buyers through a major stock exchange. Institutional buyers, someone like, let me get it right, Merrill Lynch. Merrill Lynch is an institutional stock market buyer. Merrill Lynch buys stocks and sells pieces of multiple stocks to their investors. So when you invest with Merrill Lynch, you'll get a little piece of all the pies that they have going. They are managing their investments, and you are basically just buying in for X amount of dollars. Say you want to spend $1,000, take it down in investment, and they put it in a high risk, high yield account. High risk, I mean, you could get money back or you would lose it. But the high yield is what attracts most people to those accounts, because if they make a profit, it's a big one, not just a little few bucks. Okay, so going on, we're going to talk about the markets now in the world, all around the world. So the oldest stock market exchange in the U.S. is the New York Stock Exchange, and it started in 1792. Small corporations' stocks are not listed on the New York Stock Exchange. It operates a trading floor. That's a big place. You've seen this on TV. I know, pictures of the stock market in New York City. The NASDAQ stock market, which started in 1971 in this country, is the largest stock market, the largest stock market in the U.S., and the world's first electronic. They don't have floor. You don't have to be there. So it does not reside in any single location. Home of the many of the world's largest technology-based companies is this NASDAQ. Microsoft, Apple, they trade on the NASDAQ. You can buy and sell shares of Microsoft and Apple on the NASDAQ. So membership is not limited to a fixed number of seats because it's all done electronically. Only so many people can fit here on the floor of the New York Stock Exchange. So there's only so many members allowed in that building at a time. Okay? Next we'll talk about the Tokyo Stock Exchange. And it's the third largest in the world. And it started in 1878. It's divided into sections. The first section, and that's what it's called, that's the name of it, the first section is for companies. Large companies. Okay, let me change papers here. The second, like I said, this is what's called the second section, is for mid-sized companies. And the final section is for startup companies if they want to put their stocks for exchange, and that's called the mother section. The best known TSE stock exchange in the world is called, I don't know how to say this because Nikkei, I guess, Nikkei 225. So when we talk about our stocks and net worth, owning stocks gives investors two potential financial rewards. First, you got stock appreciation. When an investor owns stock and the price of that stock rises, this is supposed to be the word worth, not worth, then the net worth increases. Another is called dividends. Dividends is when you get paid for an increase over time. So part of the company's profits are paid to shareholders as cash. And that's the second type of potential financial rewards from the stock market. Okay, we're going to pause right here, the end of this video. And you can come back to work on the rest of this with me. It's kind of long.